Meren Energy Inc. is characterized by a severe structural undervaluation stemming from recent corporate restructuring complexity juxtaposed against fundamentally robust cash flow generation and industry-leading financial stability. Meren operates as a leading independent full-cycle exploration and production (E&P) with core production assets in deepwater Nigeria and high-impact development optionality in the Orange Basin offshore Namibia and South Africa. 1.1 Investment thesis: compelling undervaluation driven by structural complexity. The core investment thesis is predicated on the substantial disparity between Meren's strong intrinsic financial health and its current market capitalization. The company successfully executed the strategic 2025 prime amalgamation to consolidate full ownership of its primary Nigerian cash engine. Post-amalgamation, management aggressively deleveraged the balance sheet, resulting in an ultra-conservative leverage profile, net debt/EBITDAX of 0.4x. This financial discipline supports an enhanced base dividend policy that translates to a high trailing yield, 12.02%, based on TSX pricing. Critically, the dividend is protected by a substantial cash flow coverage ratio of 2.16x. The market's fragmented listing and the inherent complexity of reporting based on constructed financial information post-amalgamation have depressed the valuation metrics to an unjustified extreme. With a calculated forward enterprise value to EBITDAX, EV/EBITDAX, of 2.09x. Normalizing this valuation to conservative sector peer averages suggests an implied upside potential exceeding 145%. 2.1 Meren Energy Inc. E&P Portfolio Overview. Meren Energy is a Canadian-based international oil and gas exploration and production company. Its operational focus is exclusively in Africa, managing a portfolio spanning established deepwater production, high-value development, and frontier exploration. The company is positioned as a full-cycle E&P, balancing stable cash generation with high-impact growth opportunities. The portfolio is structured around two key pillars. Deepwater Nigeria. These assets, operated by majors, serve as the company's reliable cash flow engine underpinning the distribution policy. Orange Basin, Namibia and South Africa. This forms the high-growth catalyst primarily through its effective interest in the substantial Venus Light Oil project offshore Namibia. Meren also holds operated licenses in Equatorial Guinea. Operational results for the third quarter of 2025, Q3 25, demonstrate consistent execution, with average daily entitlement production reaching 35,600 barrels of oil equivalent per day, BOPED. Cargo sales realized a favorable average price of $70.08 per barrel, BBL, during the quarter. 2.2 The strategic rationale of the prime amalgamation, 2025. A defining event for the company's 2025 financial profile was the completion of the amalgamation in March 2025, which consolidated full control and ownership of Prime Oil and Gas Cooperative UA, Meren Co-op. This strategic maneuver was designed to simplify asset ownership and afford Meren greater control over its core value drivers. For financial reporting, Meren must provide clarity regarding this transition. The financial results presented for 2025, including cash flow from operations, EBITDAX, and capital investments, are reported on a constructed financial information basis. This means the financial highlights for both the 3 and 9 months ended September 30, 2025, have been adjusted to include 100% of Meren Co-op, ensuring comparability with the current consolidated entity. The immediate consequence of assuming 100% control of Prime was the consolidation of Prime's reserve-based lending facility, which started with a balance of $750 million at the time of completion. Management's subsequent actions confirm that the objective of this consolidation was not merely to increase scale, but to establish a foundation for sustained value creation by aggressively prioritizing balance sheet strength. The high priority placed on using internal cash flow generation for rapid debt repayment, evidenced by the large reduction in RBL debt, demonstrates management's commitment to establishing strong financial resilience well in advance of the significant capital expenditure cycle anticipated for the Venus project development. 2.3 Market and exchange listing complexity. The company's investment profile is complicated by its multiple listings, including the Toronto Stock Exchange, TSX, MER, and the OTCQX, MRNFF, which have resulted in highly conflicted reported data. For instance, stock price reports range from $1.22 to $11.67, with corresponding market capitalizations varying drastically from $824 million to $8.19 billion. This market fragmentation, coupled with the transitional financial reporting, i.e., constructed financial information, introduces significant friction in standard due diligence processes. As such, a detailed reconciliation and standardization of key metrics is necessary to arrive at a defensible intrinsic valuation, as explored in Section V. The current pricing environment indicates that the stock trades as a smaller value play, small value designation, suggesting that institutional investors may still be attempting to normalize the consolidated financial structure. 3. Detailed cash flow and liquidity analysis. Rigorous examination of Meren's cash flow demonstrates exceptional capacity to self-fund its operations, service debt, and sustain distributions. For E&P companies, the most reliable metric for underlying operational cash generation is the cash flow from operations before adjustments for working capital, CFFO, as this excludes short-term timing volatility inherent in receivables and payables. 3.1. Cash flow generation and FCR reconstruction methodology. Meren reported strong operational cash flow metrics for the first 9 months of 2025, 9M25, largely driven by the stable Nigerian deepwater production. Cash flow from operations before working capital adjustment, CFFO, $243.1 million. EBITDAX, earnings before interest, tax, depreciation, and exploration expenses, $368 million. This $162.7 million cash surplus generated in the first 9 months confirms a high operational self-funding capacity well above required maintenance capex and demonstrating the core profitability of the deepwater Nigerian assets. Extrapolating this FCR generation rate for the full year 2025 yields an estimated annual FCF of approximately $216.9 million. 3.2. Deleveraging and balance sheet strength. The primary mandate following the 2025 amalgamation was the reduction of the acquired RBL facility. Meren's management pursued this goal aggressively and successfully throughout 2025. During the first 9 months of 2025, the company repaid $390 million under the RBL facility. This reduced the outstanding RBL balance to $360 million by the end of Q3. Management continued this disciplined approach post-Q3, reducing the RBL by a further $30 million. The resulting leverage profile is exceptionally low for the E&P sector. With a Q3 25 cash balance of $176.7 million, the net debt position was calculated at $183.3 million. The crucial leverage metric, net debt/EBITDAX, was reported at 0.4x as of September 30, 2025. This ratio is calculated based on an extrapolation of the 9M25 EBITDAX figure to a full-year estimate. A net debt/EBITDAX ratio is a robust demonstration of superior financial discipline. This ultra-low leverage profile provides several strategic advantages. Crisis insulation. It shields the company from typical commodity price volatility and liquidity crises, ensuring stability even during cyclical downturns. Financial flexibility. It virtually eliminates refinancing risk and significantly reduces interest expenses, freeing up more operational cash flow for distributions and growth. Valuation premium. Such a strong credit profile typically warrants a premium valuation multiple compared to highly leveraged peers, a factor currently overlooked by the market. 3.3. Interest coverage and liquidity position. The extensive RBL paydown has materially reduced the company's debt interest expenses. While some external data sources report conflicting interest coverage ratios, example 2.8x, the $390 million debt reduction and high operational profitability are consistent with the significantly higher reported interest coverage ratio of 95.75x. This metric confirms that the company's operating income far surpasses its minimal financing costs. In terms of short-term liquidity, Meren ended Q3 25 with a substantial cash balance of $176.7 million. The current ratio, which measures the ability to cover short-term liabilities, is reported as strong, ranging from 1.14 to 1.142, indicating sufficient operational cash reserves and working capital strength. 4. Dividend policy, sustainability, and safety assessment.
The assessment of Meren's dividend policy requires a focused analysis on cash flow generation, as traditional GAAP accounting metrics can be misleading in the volatile E&P sector. 4.1. The enhanced base dividend policy. The company has successfully honored its enhanced dividend policy post-amalgamation, declaring the distribution of 4 quarterly cash dividends in 2025, totaling approximately $100.3 million. The fourth quarterly dividend was approximately $25.1 million, translating to 0.0371 per share. The high trailing dividend yield, reported at 12.02% based on the TSX listing, places Meren in the high yield category. Such yields typically raise concerns about long-term sustainability, necessitating a rigorous stress test of the company's underlying cash generation. 4.2. Cash flow coverage analysis, stress testing. A superficial analysis of dividend safety based solely on net income presents a potentially alarming picture. Meren's payout ratio, using trailing 12 months (TTM), is reported at 1.01, suggesting distributions slightly exceed accounting profits.
However, in E&P, net income often includes significant non-cash charges, such as depreciation, amortization, and write-offs of unsuccessful exploration expenses. Therefore, the security of the dividend must be validated against free cash flow, FCF. Using the annualized indicative FCF calculation derived in Section 3, $216.9 million, and comparing it against the annualized base dividend commitment, $100.3 million, this FCF coverage ratio of 2.16x definitively establishes a robust safety margin for the current base dividend. The substantial buffer confirms that the dividend is securely funded by stable operational cash flows derived primarily from the Nigerian deepwater assets. This robust cash flow coverage effectively dismisses the warning implied by the 1.01x net income payout ratio, reaffirming the validity of management's dividend strategy. 4.3. Dividend growth and future capacity. Meren has only one consecutive year of reported dividend growth, reflecting the implementation of the new policy following the amalgamation. The significant 2.16x FCF coverage ratio implies substantial latent capacity for potential future increases in the base dividend or the initiation of special dividends once the RBL debt is fully retired. The ongoing optimization of the capital allocation strategy, which involves prioritizing debt reduction while maintaining the current distribution, strengthens the financial platform for sustainable future value delivery. 5. Valuation assessment and reconciliation. Meren's valuation presents a unique challenge due to market fragmentation and the transitional nature of the financial reporting, resulting in highly inconsistent reported multiples. A disciplined reconciliation using standardized, consolidated figures is essential to determine intrinsic value. 5.2. Valuation multiples calculation, forward adjusted. Applying the standardized metrics reveals a profound undervaluation relative to peers. This calculated 2.09x ratio demonstrates an extreme disconnect from fair value. Even higher reported valuations, such as the 4.2x EV per EBITDA reported on some data platforms, remain significantly below sector norms. Price to cash flow, PCF. The reported PCF of 4.72x is exceptionally low, indicating that the stock is trading cheaply relative to its stable operational cash generation. Price to book, PB. Meren's PB ratio of 0.9x implies the company is trading at a discount to its reported asset value, contrasting with the sector average PB of 1.1x to 1.2x. 5.3. Peer group benchmarking and implied fair value. Comparing Meren's valuation to E&P peers underscores the severity of the mispricing. E&P companies with stable, producing assets and moderate leverage typically trade in the range of 4.5x to 6x forward EV/EBITDAX. Meren's high PE ratio, 12.6x, relative to the sector, 4.9x, is offset by its ultra-low debt profile and superior EV/EBITDAX multiple. The valuation gap is quantified by applying a conservative peer multiple expansion.
If Meren were valued at a modest 4.5x forward EV/EBITDAX, a floor for stable E&P operations and still below many peers, the implied fair value is significantly higher. This analysis suggests a potential upside of approximately 145% from the current price of $1.22. The existing low multiple, 2.09x, is attributed to the market's ongoing struggle to correctly price the newly consolidated entity and the reliance on complex constructed financials, creating a massive valuation opportunity. Analyst consensus supports this view of substantial undervaluation. Meren currently holds an average brokerage recommendation, ABR, of 1.00, strong buy, based on 2 brokerage firms. The average price target offered by analysts is $2.05, representing an upside of 68.03% from the last closing price of $1.22. Other projections place the target price at $2.21. 6. Growth catalysts and operational risks. The long-term value proposition for Meren rests on its dual strategy: stable income generation from Nigeria and transformative growth potential from its African exploration assets. 6.1. The Orange Basin Portfolio, High Impact, Carried Optionality. Meren maintains a leading position in the promising Orange Basin. Specifically, the company holds an indirect, carried 9.5% interest in blocks 2912 and 2913B, which host the major Venus light oil discovery. The Venus development, operated by Total Energies, is massive, envisioning tying up to 40 subsea wells to a 160,000 barrels per day floating production storage and offloading vessel. Development plans are proceeding towards a final investment decision targeted for the first half of 2026, with production expected around 2030. The economic viability of the project hinges on maintaining development costs under the challenging threshold of $20 per barrel, necessary due to the extreme deepwater environment, approximately 3,000 meters water depth. The most valuable aspect of Meren's participation is its carried interest. Meren's costs are financed and carried through the development phase. This minimizes shareholder dilution and ensures that the company does not need to divert its stable Nigerian FCF away from debt reduction and dividends during the high capex development cycle, preserving its strong balance sheet profile. This carried exposure provides significant unpriced optionality to the equity story. 6.2. Key risks to Venus execution and timeline. While the Venus asset is transformative, execution risks are significant. The shift from discovery headlines to logistical execution introduces profound timing uncertainty. The primary immediate risk is the stability of the 2026 FID timeline, which is subject to political and logistical bottlenecks in Namibia. Recent market observations, such as Namport pausing Southern Harbor upgrades and canceling a Luderitz supply-based tender, inject uncertainty into drilling schedules. If these logistical hurdles are not resolved swiftly through streamlined processes, the capital commitment for Venus could drift to more predictable regions like Guyana, Brazil, or Nigeria. Delays would negatively impact the net present value assigned to the project. Furthermore, exploration risk remains inherent in frontier markets. While Venus is a discovery, exploration efforts beyond it have yielded mixed results, such as the Marula-1X well failing to encounter hydrocarbons in its primary objective, confirming the binary nature of exploration capital allocation. The current undervaluation suggests that the market is attempting to apply a bifurcated valuation approach, sum of the parts, SOT, where the stable Nigerian cash flow component is being priced at a substantial discount, and the high-impact Venus optionality is effectively being assigned zero value. The path to valuation normalization depends on either the elimination of the complexity discount or the successful progression towards the 2026 Venus FID, converting optionality into definitive growth. 6.3. Nigerian and Equatorial Guinea operational risk profile. Deepwater Nigerian assets provide relative operational stability and are operated by international majors. However, success in non-producing exploration regions, such as Equatorial Guinea, relies heavily on Meren's ability to secure favorable farm-in partnerships to fund high-cost exploration activities. The ability to influence joint venture partners to sustain and enhance production in Nigeria is also a continuing factor for cash flow consistency. 7. Conclusion. Meren Energy Inc. has successfully transitioned into a highly financially disciplined independent E&P entity following the 2025 Prime amalgamation. The core investment conclusion is that the company's strong financial fundamentals, marked by massive cash generation, rapid debt reduction, and ultra-low leverage, are fundamentally mispriced by the market. 7.1 Summary of financial strengths and weaknesses. Strengths. Deleveraging success. Net debt over EBITDAX of 0.4x provides a significant safety margin against commodity price volatility and preserves future capital optionality. Dividend security. The enhanced dividend policy is highly protected with a 2.16 FCF coverage ratio, ensuring robust shareholder returns, $100.3 million annualized, while debt reduction continues. Growth optionality. The carried interest in the massive Venus discovery offers significant long-term growth potential without immediate strain on the balance sheet. Weaknesses. Valuation fragmentation. Conflicting exchange data and complex financial reporting post-amalgamation obscure the company's true value, contributing to a deep multiple discount. Execution risk. Logistical and governmental risks in Namibia pose a material threat to the 2026 FID timeline for the high-value Venus project. 7.2 Final investment decision rationale. The analysis concludes that the market is currently assigning a risk premium to the stock that outweighs the operational realities and financial strength. The current trading multiples are unsustainable given the company's defensive balance sheet and high FCF yield. The investment decision is justified by three compounding factors. Safety margin. The low leverage profile offers exceptional downside protection, limiting capital impairment risk. Income generation. The reliable high-yield dividend compensates investors handsomely while they await market recognition of the company's true worth. Upside potential. Valuation normalization alone, moving Meren towards conservative peer multiples, implies potential returns exceeding 145%. Investors are positioned to benefit from both significant income, 12.02%, and capital appreciation as the market corrects the current structural mispricing, particularly upon successful de-risking of the Venus project post-2026 FID.